Hey everyone, welcome back to The Joyful Trader. Today we're diving into a powerful option strategy that can earn you money while you sleep. That's right, this isn't just about some clickbait cliche. We're talking about covered calls and how passive income can actually be easily created with them. Now, if you've been following my channel, you might have seen a recent video that I did about selling put options for passive income. As we know from my discussions about that strategy, sometimes we end up owning stock if it gets assigned to us. And I talk about how that's not a bad thing. Well, today's video is the next logical step for those of you in that situation. But even if you didn't sell put options and you just happen to own a bunch of stock, maybe it's not performing, maybe it's just sitting there doing nothing, well, this video is also for you. Covered calls or selling covered calls can help you generate and squeeze extra passive income from those stocks while you simply do nothing but hold on to them. So by the ending of this video, you'll understand what covered calls are, how they work, and how you can use them to boost your returns without taking on too much extra risk. We'll break down the basics, use some easy to understand analogies. We'll go through some real world examples to make sure that everything is crystal clear. And at the very end of this video, we'll walk through a short quiz to help you confirm that you have an understanding of this passive and easy way to draw extra income just from sitting on stocks. So with that said, let's get started. Hey everyone, Dan here once again, The Joyful Trader. I'm a full-time surgical nurse by day. I'm an active trader and investor, side hustle enthusiast, and I spent 22 years as the CEO of my own software company. So whether you're aiming to grow your portfolio, enhance your returns, master options trading, or just find side hustles that fit into your busy full-time schedule, well, you've come to the right place. With 30 years of experience across all of these areas, I've gathered a wealth of valuable insights and tips that I'm excited to share with you. So hit the subscribe button, ring the notification bell, stay up to date with all the latest tips, strategies, and option trading goodness. Now, before we go any further, I don't want to assume that all of you may know what a call option is in the first place, much less what selling one is. So here's a super quick, non-technical explanation as a point of reference. A call option is a contract, but think of it like a coupon, which is something that we can all relate to. And that coupon gives the person who owns it the ability to buy a stock at a certain price, but they have to do it before a certain date. And like most coupons have expiration dates, and after that you can't use them anymore. Same thing with call options. And like most coupons, you don't have to use it at all, only if you want to. Think of it like having this coupon that lets you buy a concert ticket at some set price. No matter how much the ticket price goes up later, you just pay a small fee for buying that coupon. But if the ticket price rises higher in the future as you get closer to the concert date, well, then you can use the coupon to buy the concert ticket at the original cheaper price and potentially save a lot of money. And so this concept applies to stocks, like say Nvidia. Buying a call option lets you buy Nvidia at a lower price if the Nvidia stock shoots up in the future, maybe because of earnings or some other reason that drives that stock higher. That doesn't matter. You can then use your call option, like the coupon, to buy the stock at the lower set price, even though it's now trading at a much higher price than that. And that's the quick essence of what a call option is. So a covered call is an option strategy where you already own shares of stock, hence the reason why it's called covered. And you are then selling call options on those shares that you own. The idea here is to generate extra income from the stocks that you already own by selling these call options, and I'll explain why and how in just a second. By the way, if you were selling call options on a stock that you do not own, it would then be referred to as a naked call rather than a covered call. So let's put this into an analogy. Think of it like renting out a room in your house. You own your house, that's your stock. and you decide to rent out a spare room. That's the call option. You still own the house, but now you're earning extra income from your tenant each and every month. So in the stock market, you own 100 shares of some company, and you sell a call option to someone who pays you a premium, which is a fancy word for paying you a fee, for the right to buy those shares from you at a specific price, called the strike price. And this all has to occur before a certain date, the expiration date. So why on earth would you do this? What's your motivation? What's in it for you? What's in it for them? Going back to the house analogy, let's say your house is worth $300,000, but the value of the house really isn't moving very much in today's market. Maybe it's just been sitting at that value for a long time. Maybe you'd be fine selling your house for $350,000 if and when it's ever reached at that level. But in the meantime, the price is just going nowhere, and it's maybe even slipping down slightly. But you're now renting out a room each month, and that's helping to pay your mortgage. Not all of it, but some of it. So that's good. But let's say the terms of the renter's lease says that they have the right to buy your house for $350,000 if they want to. They have first right of refusal. You already said that you'd be okay selling your house for $350,000 if you got such an offer. Well, then one day, the market for your house wakes up and you discover that your house is now worth $360,000, which is $10,000 more than what you were happy to have sold it for. You'd love to go and sell it for $360,000 right now, but wait, you can't. This is because your tenant's lease agreement says that you promised under contract to sell your house to them for $350,000 if they wanted it. Your tenant could now request that you sell it to them for that amount. And sure enough, they do that. Why is this not a bad thing for you? You must remind yourself that $350,000 was a totally acceptable price that you chose when you leased out your room to the tenant. Maybe you bought the house for $250,000 and $350,000 will give you a nice profit, you thought, even though the market is a little higher than that right now. But bottom line, you're getting what you asked for. Remind yourself that for the last 2 years, you've been collecting $1,000 a month rent from the tenant, which amounts to $24,000 in extra income just for doing nothing. So when he buys your house for $350,000, he gets a house that he bought cheaper than what the current market is. And so he wins in this regard. But you win too, because you got your price for the house that you wanted. Plus, you get to keep all of the $24,000 in rent that you collected over the last 2 years. So in this regard, this is a win for you too, because at the time that you rented the house, you had no idea if the house value was going to go higher or lower. So instead of just holding the house to wait and see what happens, you've been receiving income all that time, which has reduced your bottom line on owning that house. So if you've always believed that in the world of trading and finance, that it's a zero-sum game with a simple binary outcome where you have one winner and one loser, well, trading options sort of changes that game in such a way that you can have all sides of the trade win. And I'd rather be involved in a game where you have multiple winners at once than the binary system. I know of no other instrument that you can trade in that allows for this. So let me break this down a little bit more with some key terms. Stock, it's the shares that you own. Imagine this is your house. The call option, this is the agreement that you sell that allows someone to buy your stock at a set price. This is like the rental agreement. Premium, the money that you get paid upfront for selling the call. Think of this as the rent that you receive from your tenant. Strike price, this is the price at which the buyer of the call option can buy your stock. This is the agreed upon price for selling your house. Expiration date, this is the date by which the buyer must decide to buy your stock or not. This is like the end date of your rental agreement or when a coupon expires. So in a nutshell, you're getting paid the premium for potentially selling your stock at a higher price, the strike price. And if the stock doesn't reach that price by the expiration date, you get to keep both your stock and the premium that you were paid. So let's suppose that you own 100 shares of Company XYZ, and that's currently trading at $50 a share. You bought the stock at $45 a share, so you're already up $5. You decide to sell a call option with a strike price of $55, expiring in 1 month. The price for that option is $2 per share multiplied by 100 shares, because that's how many shares a single options contract controls. So here's the equation. You have a stock price, $50 per share, which equals $5,000 in assets to you. You have a strike price, which is $55 per share, which is $5 higher than what it's trading for right now. You're selling a call option for $2 a share, which is the premium. So we take the premium collected, $2 times 100 shares, and that gives you a $200 income. So you get $200 upfront for selling the call option. Now, two things can happen by the expiration date. First thing, stock price stays below $55. The call option expires worthless, meaning the buyer doesn't exercise the option. Why would the buyer of the option use it to pay $55 for a stock that they can just go out on the open market right now and get for less than that, say $50 or $45, whatever it's currently trading at? Doesn't matter. It's less than $55, which is a strike price. So they don't need to use your call. It just wouldn't make sense. So that means you get to keep your 100 shares of stock and the $200 premium that you collected for selling the call option, like the rent. Second scenario that could happen, the stock price rises above $55 to $58. So now it does make sense for the buyer to exercise the option and for you to sell your shares to them at $55 each. The buyer of your call option wants to exercise that contract because now they can buy a $58 stock for $55 from you, which was the strike price that you both agreed to. However, you still get to keep the $200 premium that you collected, plus you make a profit from selling your shares at $55 anyway. So let's calculate the total profit if the stock price goes up. The profit from selling the shares, $55 minus $45, what you bought it at, times 100 equals $1,000. Plus, you get to keep the premium, which was $200. So your total profit between the two is $1,200. And there you have it. That's how a covered call works. It's a great way to generate extra income from the stocks that you already own, especially if they're not doing much price-wise. And if the price of your stock never reaches the strike price of your covered call, then you simply just get to keep the premium, again, like the rent from a renter. And you can turn around and sell another call option over and over again, just like renting out your house's room month after month. Each time you sell another call option, you can change the strike price to anything you want. Perhaps a price that is unlikely to happen, just so that you can keep collecting the premium over and over, yet still own the stock. In fact, if the price of the stock is creeping upward, then each time you sell a call option, you can make the strike price just a little higher than that over and over, so that the value of your stock continues to go up, but you're still collecting option premium or income by selling a call. And that's how you generate income, just simply by owning stock. And I'm not even talking about income that might come from dividends or from other means from owning the stock. I've talked to a lot of friends of mine that are sitting on a lot of stock. Maybe they inherited stock or they just accumulated it over the years passively through companies that they work for or whatever. And so they have all this stock, but they're not doing anything with it. It's just sitting there, and the value goes up, the price goes up, but they're really not doing anything. And I've talked to a lot of these friends about, hey, did you know that you could do this? Like, you're owning all this stock, you have thousands of shares of this. Did you realize that you could sell covered calls and you could bring in more income? And they have never heard of this concept before, but I can tell you that big, smart investors, people like Warren Buffett, other big funds, they do this all the time. This is a significant portion of the many strategies that they employ to grow their income. So it just stands to reason that we as retail investors can do the same thing. And I knew many, many retail investors, including a significant trading mentor of mine, that taught me all about this. I've employed it in my trading strategies. It's just yet another way to add a few hundred or a few $1,000s a month into your income stream, which you can then use to pay bills, or you can just divert it right back into your portfolio and buy more stock. All right, now that we have a good understanding of what covered calls are, let's talk about the benefits of using this strategy. So there's several reasons why covered calls can be a great addition to your trading toolkit. Number one, like I've already said, extra income. One of the biggest advantages of covered calls is extra income that you generate from the premiums. Each time you sell a call option, you get paid up front. And this can be a great way to boost your overall returns, especially if your stock isn't moving much in price. Think of it like getting a bonus check just for owning your house. You're still the owner, but now you're making a little bit more money on the side. The second upside, downside protection. The premium you receive from selling call options provides a small cushion against any drop in the stock price. If the stock price falls, the premium can help offset some of those losses. I mean, anything that you can get to offset losses is a plus. If you lose $1,000 in value, but you make $200 or $300, you've only lost now $700, and to have anything buffer that is how you win in the long run. Another positive, enhancing returns. By adding the premium income to your overall returns, covered calls can enhance the profitability of your stock holdings. This is especially beneficial in a very flat or slow rising market where stock price gains are minimal. Imagine you have a garden, and besides growing vegetables, you also plant some flowers to sell. The flowers are your extra source of income. They're boosting your total earnings from the expenses of owning that garden. Another positive, predictable income. Selling call options on a regular basis can provide a predictable income stream. This can be particularly appealing for retirees or anyone looking for consistent cash flow from their investments. Think of this as sort of having a part-time job that pays you regularly, but you don't have to go to work anywhere. You're already working your full-time job. Your stocks are doing the work for you. So those are some of the main benefits of covered calls: extra income, downside protection, enhanced returns, and predictable income. All right, so we've talked about the benefits of covered calls. Now let's discuss some of the potential downsides or the risks that come with this strategy. I mean, after all, it's important to understand both sides so that you can make informed decisions. The first downside is limited upside potential. One of the main drawbacks is that your profit is capped. If the stock price soars above the strike price, you won't be able to benefit from those extra gains because you've already agreed to sell your shares at the strike price. For example, imagine you rented out your spare room and then suddenly someone else comes along and they offers you double the rent. Unfortunately, you can't take the new offer because you've already locked into your current rental agreement with the first person. The same is true here for selling a covered call on the stock you own. If your strike price is $55 a share, but the stock's open market price has soared to $70 a share, you're still obligated to sell at the $55 price. Another potential downside requires ownership of 100 shares. So you need to own at least 100 shares of the stock to sell one call option. And this is because in the world of options, each option contract represents a controlling interest in 100 shares of stock at a time. Option contracts bundle stocks in groups of 100 at a time, so this is something to keep in mind when you're buying or selling options. Because of that, this can be a barrier if you don't have the capital to invest in that many shares of a company. If you only own 50 shares of the company's option contract that you sold, and if you are exercised, you'll still need to come up with the capital to cover the other 50 shares in order to make it 100 shares. However, this strategy comes into play really well if you're selling put options. You can find more out about that in a video I made recently about creating income by selling put options, but sometimes you end up owning the stock just like we're talking about here. Another downside is the potential for missed opportunities. So if the stock price rises significantly after you sold the call, you might regret having limited your gains. This could be frustrating, especially if you strongly believe in the long-term potential of the stock. So while covered calls can provide extra income and protection, they also come with trade-offs like capped profits, potential need to sell your shares. However, with all of that being said, there are methods that you can employ based on statistical probabilities that will help you get an idea of where to set your strike price so as to minimize the chances that you will be assigned and that you can just continue to take in premium income, yet still retain your shares. Optimally, that's what the goal would be here for this strategy. In upcoming videos, I'll dive into the weeds about how to structure these type of trades so that you can reduce the risk of assignment while still continuing to consistently sell calls and earn income. All right, now that we've covered both the pros and the cons of covered calls, let's go over some practical tips for getting started. These tips will help you use this strategy effectively and avoid common pitfalls. First tip, choose your stocks wisely. Select stable, well-established companies that you believe in for the long term. Look for stocks that aren't too volatile. For example, avoid meme stocks. I would avoid stocks that are less than $10 a share or $5 or penny stocks. These are not the kinds of instruments that you want to sell calls on. You want to sell calls on stocks that are big names, they have a good track record, they're solid stocks. Additionally, timing is key. Sell call options when the stock price is near the resistance level. That means the price point where it tends to face selling pressure and struggles to go much higher. If you can set your call price right above that, then the odds are high that you'll simply get to keep the premium while the stock backs down. This increases the likelihood that the stock will stay below the strike price, allowing you to keep your shares and the premium. This strategy can be great if you own stocks that are in a declining trend, because the odds of them popping up high enough to trigger your strike price are far less likely, making it more likely that you will continue to accrue the premium that you're being paid over and over again. So if you are holding stocks that are kind of flat, the price isn't really moving anywhere, or it's on a slight decline, those are good opportunities to utilize the strategy on, because as your stock goes down and you're consistently selling a little bit higher calls, then the odds of the stock jumping up and hitting it are going to be less, and your odds of consistently over and over again reaping in premium are high. Manage your trades. Keep an eye on your positions and be ready to act as needed. If the stock price moves significantly, you might just want to buy back the call option early to avoid assignment and having to sell your shares. Yes, you can do that. You can buy your call option back. Even though you sold it, it doesn't mean that at some point in time you can't buy it back when its value is a little bit lower and you get to pay less to get it. You can cut your trade short, in other words. Use covered calls in a conservative portfolio. This strategy works best for generating additional income in a relatively stable portfolio. It's really not suited for those high-risk speculative stocks like GameStop or whatever else. I mean, you just go on Wall Street Bets and you can, pick a dozen of those. This is not really the strategy for that. Another tip, start small. If you're new to covered calls, just start with one position to get comfortable with how it works. And as you gain experience, you can easily scale it up. It's like learning to ride a bike with training wheels. Start slowly and steady, then gradually take on more as you gain confidence and as your account size grows. All right, before we wrap up, let's test your knowledge with a quick quiz. I've got a few questions here to see how well you understand covered calls. Each question will have 4 choices, so let's see how you do. Ready? Let's go. So question number 1, what is a covered call strategy? A, buying a call option on a stock that you don't own. B, selling a call option on a stock that you do own. C, buying a put option on a stock you own. Or D, selling a put option on a stock you don't own. Well, the answer is B. It's selling a call option on a stock that you own. And this strategy is intended to generate extra income from stocks that you already hold. Question number 2. If you sell a call option with a strike price of $55 and the stock price rises to $60, what happens to your share? A, you get to keep the shares and the premium. B, you must sell your shares at $60. C, you must sell your shares at $55. Or D, you lose your shares without any profit whatsoever. And the answer is C. You must sell your shares at $55. You agreed to sell at this price when you sold the call option. All right, question number 3. What's the main benefit of selling covered calls? A, unlimited profit potential. B, guaranteed stock price increase. C, generating extra income through premiums. Or D, avoiding any risk in the stock market. And the answer is C, generating extra income through premiums. You get paid a premium upfront for selling the call option. All right, question number 4. If you own 100 shares of a stock priced at $50 and you sell a call option with a premium of $2 a share, how much premium do you collect? A, $50, B, $100, C, $150, or D, $200? The answer is D. It's $200. You receive $2 a share for 100 shares. Question number 5. Which of the following is a downside of covered call? A, high initial investment cost. B, limited upside potential. C, complete loss of the stock. Or D, no income generation. Well, the answer is B, limited upside potential. Your profit is capped at the strike price plus the premium you receive. Question 6. What is the total profit if the stock price rises to $60 and you sold a call option with a strike price of $55? A, $500, B, $600, C, $700, or D, $1,000? The answer is C, $700. You earn $500 from selling shares at $55 plus the $200 premium you collected when you sold the call. Question 7. What should you look for when choosing stocks for covered calls? A, highly volatile stocks. B, well-established stable companies. C, penny stocks. Or D, stocks with no trading volume at all. The answer is B. Well-established, stable companies, they're less likely to have extreme price movements. Question 8. How does selling a call option provide downside protection? A, by limiting losses to the amount of the premium. B, by ensuring the stock price will rise. C, by guaranteeing the stock price will not fall. Or D, by avoiding stock ownership. Well, the answer is A, by limiting losses to the amount of the premium. The premium offsets some losses if the stock price does fall. Question 9. When is a good time to sell a call option on your stock? A, when the stock price is at its resistance level. B, when the stock price is at its support level. C, when the stock price is extremely low. Or D, when the stock price is extremely high. Well, the answer is A, when the stock price is at its resistance level. This increases the chances that the stock will stay below the strike price. And finally, question 10, what does it mean to be assigned in options trading? A, the option expires worthless. B, you must sell your shares at the strike price. C, you keep your shares and the premium. And D, you must buy more shares at the market price. Well, the answer is B. You must sell your shares at the strike price. The option buyer exercises their right to buy the shares. So how did you do? I hope these questions helped to reinforce what we've covered here today. And remember, the key to mastering covered calls is practice and understanding the fundamentals. If you have any questions or you need further clarification, feel free to leave a comment down below. And additionally, if you've been selling covered calls in your strategies, let us know how you've been designing planning your trades. Don't forget to like this video, subscribe to this channel, and hit the notification bell so that you never miss an update. So that's a wrap on covered calls. We've just covered some of the basics here, the concepts that drive what this strategy is about, along with some pros and cons, and some practical tips to help you get started. Remember, like any investment strategy, it's important to do your own research and consider your individual financial goals and your risk tolerance. Thanks for watching, and as always, trade wisely, live fully. See you next time.